Well, hello and welcome to International Wealth Builders Radio Talk Show. I am your host, Michelle Estelle, the Homebuyer Coach, here on KCAA Broadcasting Network on 1050 AM and 106.5 FM. We are affiliated with NBC, CNBC News, and NBC Sports, and we cover over 5 million households in the greater Los Angeles area. If you have missed any of our previous shows, you can watch them on our TV streaming device distribution on Roku TV, Amazon Fire TV, and Android. Just subscribe to the Building Solid Foundations channel. Okay, so today I am Michelle Estelle, your homebuyer coach, and today we're going to cover loan level price adjustments. You might have heard this in the news. We're going to take at least a few segments, if not the whole show, to kind of explain and talk about what loan level price adjustments are. And if we have any time, we might go back and touch a little bit on the previous episode last month with generational wealth. I might just summarize that. But we're going to get into loan level price adjustments. About a month ago or so, if you're on Instagram, if you're on the news, you would have heard many outlets talking about how poor credit buyers were going to get a break at the expense of good credit buyers. And that was basically the focus of the conversation. So what I'm going to do today is explain what loan level price adjustments are, because they've always existed. It's nothing new. And we're going to jump into whether or not what we were seeing was true. We're going to jump into if they were trying to maybe cover up something, or the fact that influencers and media outlets were putting it out there and other people were saying that it wasn't true or that was entirely false. Well, what was actually false about it? What was true about it? And how do we break this down? So let's begin. So first off, loan level price adjustments, LLPA, they've always existed. And basically what that is an add to the rate in the form of discount points for high risk or for risk adjustments for a riskier borrower. A riskier borrower is going to pay a higher interest rate. The reason for that basically is because if a lender has to foreclose on your property, it costs them money. And obviously nobody wants to default and the lender doesn't want you to default. So we'll save that for another time. But loan level price adjustments are for risk. So oftentimes a realtor or a client would give me a call and ask me, what is the rate? Or even, what is your rate? And what I've always said is there's not a one size fits all rate. There's different programs that have different rates. And then there's certain aspects, risk aspects to the loan that will change the rate from one person to another. So the first one is what's called loan to value. The amount of down payment that you have determines your loan to value. So just for the sake of visual, since you're listening to this and you might need some visuals. So easy math, $500,000 home with $500,000 loan is 100% financing. The house is worth 500 and the loan is 500. So that's 100% financing. When you put 5% down, that's 95% financing or 95% loan to value. And so on. 10% down, 15% down, 20% down, 50% down. Obviously, the more down payment you have, the more investment into this property, the more that you have to lose, which can be a motivation for paying your mortgage or selling your home if you have to get your equity out. So that is the first risk to the lender. As I mentioned, if the lender had to sell your home, it would cost them about $30,000. As a sidebar, they also have mortgage insurance when you have a low down payment. And that mortgage insurance helps mitigate that cost for the lender. So they get insurance paid to them when you default. That's what mortgage insurance is, paid by you for the benefit of the lender. Maybe we'll talk a little bit more about mortgage insurance later. So the second risk is a FICO score. So the better your credit is, statistically, the better your performance, your willingness to pay, and your ability to pay your debt may be. So risk in credit performance is the next risk. So if you have a high FICO score and substantial credit, lots of years of having credit, lots of years of paying your debt on time, you are statistically a lower risk. And if you have harmed credit, for whatever reason. We all do at times. But if you habitually don't pay your debt or get into trouble or have not had great plans and have found yourself not being able to pay your bills and things like that, or you had an illness or a death or an accident or an illness, obviously those things sometimes make it hard to pay your bills. So some really valid reasons why people might have harmed credit, and then some irresponsibility. Let's face it. So your credit score statistically says what risk you are for default, if I could summarize it. And so that's a different risk. Then there's also properties. So manufactured homes and condominiums, they have a loan level price adjustment because the property, and that's just looking at what the lender feels like. The lending on a condo and the lending on a manufactured home are a little bit more risky than a single family stick built home. So there's an ad there for a condo, an ad there for a manufactured home. Again, this is an ad in the form of discount points. And the last thing, which really isn't a risk, but was discussed for loan level price adjustments, and there's a little bit of back end things with this, is your debt to income ratio. So the lower your payment is in accordance to your gross income, that's also considered a less risk. So the higher your debt ratio is for the housing and debt, the more risk you might be. So for instance, an FHA loan is more risky because they allow for such a high debt to income ratio, which is why no matter what loan to value you have on an FHA loan, you have the mortgage insurance for the benefit of the lender in case you default. So that's basically in a nutshell loan level price adjustments, and they've always existed and they've changed over time. So this isn't the first time that there's been a change. But the reason why this one hit so hard is, I believe, the way that the changes were made and who was affected the most and who benefited the most. Now, they might want to try to tell us that they might even want us not to think that there is a winner loser in this situation, and maybe not. However, it is very clear that it is not clear that what the media said, that a person with bad credit will benefit more or have a lower rate. The lower rate part that they say is not accurate. And the higher rate for better borrowers, that's a little bit more questionable. So basically what has happened is for deliveries, not for closings, not for loans just in May, but for deliveries to the two agencies where loan level price adjustments prevail, which is basically your conforming Fannie Mae, Freddie Mac loans, and that's what these LLPAs are, is that these adjustments were shifted where a lower score borrower with a lower down payment, possibly the lowest down payment, does in fact get an improvement to their particular situation. So just in comparison to themselves and nothing else, that particular borrower group that might have a 620 score and only 3% down definitely got a lift. Those loan level price adjustments went down. They're not getting a credit. That was one of the misunderstandings, because the heat map showed that it looked as though they were going to get a credit back and that the others were going to pay or have a lesser credit. So that was kind of a misunderstanding. What the heat map was showing was how much the change was going to be. So again, for the sake of easy math, let's say that a borrower with a 620 score and a 3% down used to have LLPAs that equaled 3 points. Well, now they might only be paying a 1 1/8 points. So they got a huge reduction in the loan level price adjustment, even though they're the riskiest borrower on the grid. The lowest score, the lowest down payment. So the more harmed credit and the less down got a huge break. They're still paying points. They're still paying LLPA. However, their particular grid, their particular cell on the grid did see a huge improvement. Now, the borrowers that are in the middle of the grid, which I like to call like the middle sector, they have about a 680 score, moderately good score, and they might have 5 to 10% down, which is pretty decent. It's better than 3 for sure, and a 680 score to a 720 score was before considered very good credit, or at least good credit. Well, their loan level price adjustments increased, so they definitely got penalized for nothing. They're just going along having good credit and saving money or getting gifts or whatever their current situation put them in, that they were able to have 5% or more down payment, and they are now paying a higher loan level price adjustment. So no matter how you slice that, it does feel a little off, because the non-risk or the less risk borrower is now paying more, and the higher risk borrower is now paying less, which really feels like what everybody thought, and that your middle sector is subsidizing your lower sector. So that definitely, to me, is the case. So what we're going to get into in the next segment is the message that we got that you should have bad credit and you'll get a better rate, because that one is not quite accurate. So in the next segment, we're going to go ahead and discuss specifically the credit piece of this, and how harming your credit is not going to get you a better interest rate, which is the false part. But the truth is, if you have good credit, you are paying more to subsidize for people who don't have such good credit. That is true. And we'll be right back.